Your client walks into your office and drops an IRS notice on the desk. The assessed liability is massive. It carries months of accrued penalties and interest, and the client has absolutely no idea how the number got so high. The IRS collection apparatus is already in motion. It operates like a machine, slowly and mechanically closing in on bank accounts, wages, and physical assets. Faced with this threat, the default reflex for most tax professionals is to immediately evaluate the client's ability to pay. They start running a reasonable collection potential analysis to see if the client qualifies for an offer in compromise based on doubt as to collectability. This initiates a highly invasive process. You compel the client to produce 6 months of bank statements, detail their living expenses, and expose every financial asset they own on Form 433. The problem with this workflow is the assumption it makes. By jumping straight to a financial analysis, the practitioner implicitly accepts that the IRS's initial tax assessment is legally and mathematically accurate. There is an entirely separate framework authorized under Internal Revenue Code Section 7122, doubt as to liability. This path ignores the taxpayer's wallet completely. It focuses the challenge squarely on the accuracy of the IRS's math and the agency's legal standing to assess the debt. Running a financial analysis before a legal diagnostic guarantees some clients will empty their savings to pay a structurally flawed assessment. The primary reason practitioners avoid doubt as to liability is a mental block. They assume they must definitively prove the client's true tax liability is exactly zero to win the case. The actual legal standard, defined in Treasury Regulation 301.7122-1.b.1, is much lower. It requires only a genuine dispute regarding the correct tax liability. This diagram illustrates the statute. You don't need absolute certainty of a zero balance. You only need the lower threshold of genuine doubt. That standard applies whether challenging the debt's existence or the calculated amount. Once genuine doubt is established, absolute proof is removed. The specific benchmark is straightforward. You only need to show that a reasonable person reviewing the facts would question the accuracy of the IRS assessment. When you replace absolute proof with genuine doubt, you find workable options for a massive segment of IRS assessments that practitioners typically ignore. The first major category where this applies is IRS audit and estimation flaws. When the IRS lacks complete records, examiners frequently use the bank deposit method. This methodology routinely flags non-taxable deposits like business loan proceeds, owner capital contributions, and inter-account transfers as taxable revenue, artificially inflating the assessment. Take a client whose restaurant records were destroyed in an office flood. The IRS audited the business using third-party estimates and assessed a $95,000 liability. The countermove requires systematic record reconstruction. By pulling 3 years of bank statements directly from the institution and matching them with credit card statements and vendor invoices stored on a surviving cloud server, the exact income and expenses can be rebuilt. Based on the reconstructed records, the IRS accepted a true liability of $31,000. Asking the right diagnostic question saved the client $64,000. The second major application targets IRS administrative misapplications. Taxpayers frequently make meticulous estimated payments, sending checks via certified mail or initiating bank wires, only for the IRS to fail to credit those payments to the correct tax periods. To prove the error, you construct a payment reconciliation table like this one. On the left side, we have the verified, certified mail receipts and bank wire confirmations. On the right, we have the official IRS account transcript. Mapping the taxpayer's verified payments directly into the missing gaps on the transcript forces the IRS to acknowledge the uncredited funds. In this specific case, resolving the administrative error dropped an assessed balance of $48,000 down to $4,200. A similar administrative flaw happens with substitute for return assessments. The IRS generates an SFR using third-party income data, but completely ignores allowable business deductions, guaranteeing an overstated liability. IRS data is frequently incomplete or administratively flawed. Treating an initial assessment as factual gospel is professional negligence. The third category of doubt as to liability applications centers on legal responsibility disputes. This moves past mathematical errors and administrative misfires to ask a much simpler question: is the IRS billing the correct legal entity? Consider a partnership that formally dissolves, or a partner who exits a business. That legal relationship is severed. In one case, a former limited partner was assessed $180,000 by the IRS for a tax liability generated by the partnership 2 full years after her formal withdrawal. The practitioner proved non-liability by submitting the client's original withdrawal agreement alongside the amended state partnership filings. She had no legal connection to the debt. During negotiations, the IRS recognized her position, but countered to account for a minor residual exposure from her actual ownership period. The case closed for $18,500. A taxpayer's ability to pay a debt is entirely irrelevant if they are not the legal entity responsible for generating it in the first place. Let's look at the procedural mechanics of filing a doubt as to liability offer. The submission package requires 4 core components: the Form 656L application, a structured written statement, an indexed exhibits folder, and a proposed offer amount. Just as importantly, there is no Form 433A, no Form 433B, and no application fee. The entire submission rests on the quality of your factual and legal argument. You completely ignore the client's financial distress. But there is a critical procedural trap built into the doubt as to liability process. Unlike a standard offer based on collectability, filing a Form 656L does not automatically suspend active IRS collections. To protect your client from active levies while under review, simultaneously file Form 12153, the collection due process request. This effectively jams the gears. Submitting a liability dispute without a simultaneous collection due process request is a procedural error that leaves your client completely exposed to asset seizure. Some highly complex cases present both legal and financial hurdles at the exact same time. If your client has a legitimate dispute regarding the assessment amount and they cannot afford to pay even that disputed amount, you are permitted to file both a doubt as to liability offer and a doubt as to collectability offer simultaneously as separate applications. For enrolled agent exam candidates, there are specific post-submission metrics you need to master. First, confirm that a Form 656L submission requires a $0 application fee. Second, if the IRS rejects the offer, the taxpayer has a strict 30-day window to elevate the case to the IRS Office of Appeals. Third, an accepted offer triggers a mandatory 5-year compliance period. If the taxpayer fails to file or pay on time during those 5 years, the default reinstates the original assessed debt, minus any payments already made. This brings us back to the diagnostic error we established at the beginning. Look at this corrected workflow. When a new client file enters your practice, the first diagnostic gate must be, is the debt correct? If the answer is no, the file routes immediately to Form 656L, challenging the legal accuracy before any financial analysis begins. Proficiency and doubt as to liability changes your objective. You stop negotiating payment terms for IRS errors and start identifying the specific legal and mathematical flaws that make those debts invalid.